The biggest lies that you've heard about commercial property are probably stopping you from building real wealth. I need a 40% deposit, commercial loans are too risky, and vacancy kills returns. It sounds familiar? These are the myths that keep everyday investors from stepping into one of the most powerful wealth building strategies available. I'm Alex Watson from Funded Finance, and today we're going to break down these misconceptions one by one and show you how commercial investing can actually be more predictable, secure, and scalable than you might think. Myth: I need a 40% deposit. This is probably the most common myth I hear. The idea that commercial property is only for the ultra wealthy because you need massive capital up front. It's just not true anymore. And while some lenders might prefer a 30 to 40% deposit for a higher risk asset, the reality is that most quality commercial loans can be secured with as little as 20 to 25% down, especially if the property is well leased in a stable location. And here's the part most people miss. Lenders assess commercial property based on the strength of the lease and the tenant, not just your personal income. If there's a strong long-term lease in place with a solid tenant, that lease becomes part of the security. And that means perceived risk goes down and your borrowing options go up. Now, I've worked with clients who've used equity from their residential portfolio to fund the deposit on a commercial property, then use the cash flow from that commercial lease to cover the loan repayments and still have surplus income left over. So no, you don't need to be sitting on a mountain of cash. You just need to understand how to structure the deal and present it correctly to lenders. Commercial loans are too risky. When people say commercial loans are risky, what they often mean is, I don't understand how they work. The risk isn't in the loan, it's in the strategy. So let's talk about how they differ from residential loans. Commercial loans often have shorter terms, 5 to 15 years, and they're usually interest only or structured differently from a standard home loan. And that flexibility actually gives you more control if you know how to use it. Interest rates might be slightly higher, but that's balanced by higher yields. And while a residential property might return 3 to 4% gross, a good commercial property can actually deliver upwards of 6 to 8%, sometimes even higher. And that difference can mean the property pays for itself and still leaves you a buffer. And yes, the banks do look more closely at a tenant's financial situation and lease agreement, but that's what makes it safer. They're not relying on the emotional ups and downs of the residential market. You're relying on contracts, cash flow, and business. And if you're strategic about it, diversifying across different asset types, working with experienced brokers, and structuring your loan properly, the risk is controlled and often far less volatile than most people assume. Vacancy kills returns. Now, here's another big one. People think if the tenant leaves, I'm stuck paying the whole loan myself. But the truth is, vacancy risk can be anticipated, mitigated, and actually managed. When you buy the right kind of property in the right area with strong demand for that type of space, vacancies are rarely long term. For instance, an industrial warehouse near a major logistics hub will always attract a new tenant quickly. The key is due diligence, looking for assets with flexible layouts, solid infrastructure, and a tenant mix that suits local demand. Work with buyers agents who specialize in commercial properties, someone who can actually identify areas where vacancy rates are low and rental demand is high. In fact, many of our clients prefer commercial property precisely because the tenants are responsible for the outgoings. Things like maintenance, rates, insurance. That means even with short vacancy periods, the net yield remains far more active than residential property over time. And if you want to get really strategic, some investors actually build a cash buffer or use offset accounts to cover a few months of repayments. And that way, even if vacancy happens, it doesn't derail your portfolio or your peace of mind. Now for a real world example. Let's talk about one of our clients, a young couple who started in residential property, wanted stronger cash flow. They leveraged the equity in their first two homes to buy a small commercial property, a little retail space in a growing regional hub. And it was actually leased to a national brand on a 5-year term. They invested just under 200 grand as their deposit, but the property generated around 7.5% net yield, far outpacing the returns of their resi investments. And over the next 2 years, that steady income not only paid down their loan faster, but helped them qualify for another purchase sooner. And that's what happens when you replace fear with strategy. The myths around commercial investing exist because most people never look past the headlines. You don't need a 40% deposit. You don't have to take on crazy risk. And vacancy, it just doesn't have to be a nightmare at all. And when you understand the mechanics, the lending structure, the lease profile, the cash flow dynamics, commercial property can actually be one of the most stable and rewarding paths to financial freedom. If you want to explore what's possible for your situation, click the link below to book a free strategy session with my team at Funded Finance. We'll help you structure your finance, analyze your options, and create a roadmap for your funded future. I'm Alex Watson from Funded Finance. Thanks for watching, and I will see you on the next one.